Most people enter the market with only one story in their head. Buy, hold, hope. That is not investing. That is direction worship. And direction worship is one of the most expensive habits ever sold to ordinary people. I want to start with something the public does not like to hear, because it sounds dark, uncomfortable, and a little impolite. A market is not a machine that only rewards optimism. A market is a machine that reprices reality. When reality gets worse, some people lose money because they were positioned for hope. Other people make money because they understood that every market has a reverse gear. That is the mother line of this story. Every market has a reverse gear. Most people never learn how it works because the financial industry finds it much easier to sell the romance of upside than the mechanics of downside. Up is simple. Up is cheerful. Up attracts accounts, headlines, and television smiles. Down is more complicated. Down forces people to confront fragility, debt, leverage, fear, and the possibility that they were never investing at all. They were simply passengers enjoying a rising escalator. I have never liked being a passenger, and I have never trusted any market participant who only knows how to live in one direction. That is why I want to talk to you about shorting, inverse exposure, margin, stock lending, and the much more practical question hiding beneath all of it. Not whether you should become some dramatic hero trying to bet against civilization every other Tuesday. That would be foolish. The real question is whether you understand what happens when the market drops, who gets paid, who gets trapped, and what a regular person should actually do when the reverse gear becomes more important than the accelerator. The public loves stories like The Big Short because it flatters the viewer into thinking the main lesson was genius. A weird man with a hard stare saw what nobody else saw, made a legendary bet, and got rich while the world burned. Fine. There is some truth in that story, but the deeper lesson is not cinematic brilliance. The deeper lesson is that the market is not morally committed to going up. If the structure underneath an asset is rotten enough, you can profit from the decline just as you can profit from an undervalued rise. That is a much more useful lesson. So let me explain it the way I think about it. Most people learn only the forward gear. Buy a stock at 50, watch it go to 70. Sell, collect the difference. That is familiar. It feels natural. You buy something you do not yet. You wait for it to become worth more, and you exit higher than you entered. That is the basic long-only story. Shorting flips the machine around. Instead of buying first and selling later, you sell first and buy later. That sounds strange because it is strange. But once you understand the structure, it becomes obvious. Suppose there is a business you believe is overvalued, fragile, fraudulent, silly, or simply too expensive relative to reality. Maybe the balance sheet is weak, maybe the business model is stupid, maybe the market has become drunk and bid the shares far beyond what sanity can defend. In an ordinary long position, you would simply avoid the stock. In a short position, you do something much colder. You borrow the stock, sell it now while the price is high, and then hope to buy it back later after the price falls. That is the reverse gear. You are not buying optimism. You are borrowing optimism from someone else, selling it into the market, and waiting for disappointment to cheapen the price enough that you can buy it back for less than you sold it. If I borrow 10 shares at $50 and sell them immediately, I collect $500. If the stock falls to 30, I can buy those 10 shares back for $300, return the shares I borrowed, and keep the $200 difference less costs. In plain English, I got paid because reality moved downward. This is what the public finds morally confusing, because the public still carries a child's model of markets. In the child's model, buying is constructive and betting against something is somehow dark, cynical, or unpatriotic. That is nonsense. A short seller is often doing nothing more than expressing the view that price and reality have drifted too far apart. Sometimes he is wrong, often spectacularly wrong, but the act itself is not evil. It is just the reverse gear. And that reverse gear tells you something important about the system. Markets are not designed to reward hope. They are designed to reward positioning. That is the first identity flip. The amateur asks, "What good company should I believe in?" The allocator asks, "Where is price detached from reality? And what is my asymmetry if the detachment closes?" That is a different level of thinking. Now, before the public gets too excited and imagines shorting is just long investing turned upside down, let me tell you why it is one of the most dangerous games in all of finance. A long position has a natural floor. A stock you buy at 50 can fall to 0. That is awful, but it is finite. Your loss is capped at what you paid. A short position has no such mercy. If you short at 50 and the stock goes to 70, you lose. If it goes to 100, you lose more. If it goes to 200, you lose more still. In theory, a stock can rise forever while your short bleeds. That means the loss profile is not symmetrical. Your gain is capped at 100% if the stock goes to zero. Your loss is theoretically unlimited if the stock rises hard enough. That is why I call the second mechanism the infinity problem. People are attracted to the reverse gear because the idea is elegant. Find the fraud, spot the bubble, bet against nonsense. That sounds intelligent, and it can be intelligent. But intelligence without respect for the infinity problem becomes self-harm. If you are wrong on the timing, wrong on the catalyst, wrong on the crowd's ability to remain insane, or wrong about how much forced buying can squeeze the price against you, a short can ruin you faster than a bad long ever could. This is why the great shorts of history are so admired, not merely because they were right, but because they survived being early. Being early on a short can feel identical to being wrong for a very long time. That is what people forget when they romanticize the big short. The pain is not only in the idea, it is in the path. You can see a rotten structure correctly and still be punished brutally before the market catches up. You can be right on the fundamentals and wrong on the calendar in ordinary life. Being right eventually feels good enough. In a short position, being early can bankrupt you before eventually arrives. That is where margin enters. To short, you usually need a margin account. A margin account is not just a boring form your broker asks you to sign. It is the legal and financial machinery that allows the broker to protect itself first, and you second, if at all. Because when you short a stock, the broker is carrying the risk that the borrowed shares could rise violently, while you cannot or will not cover the loss. The broker is not interested in your philosophical conviction. It wants collateral. So the broker requires extra funds, extra room, extra capital, sitting in the account to cushion adverse moves. This is the third mechanism, what I call the collateral leash. The leash matters because the broker is not your partner. The broker is the landlord of the reverse gear. If the stock rises enough and your account no longer has enough collateral to reassure the broker, you get what is called a margin call. That is one of the coldest phrases in finance because it sounds technical and harmless. It is neither. A margin call means the broker is telling you to put up more money immediately or your position may be closed for you. Not tomorrow. Not when you feel emotionally prepared. Now, that is the broker protecting itself from your conviction. This is where shorting destroys people. Not because the thesis was absurd, but because the capital structure could not survive the path. The broker does not care that your model still says the company is ridiculous. The broker cares that the stock is now 90 instead of 50, and your account is no longer safe enough for its comfort. So it forces you to add cash or forcibly buys back the shares for you, locking in the loss. That is why I always say a good thesis with fragile funding is still a bad position. A margin call is the market's way of reminding you that being directionally right is worthless if your structure cannot survive the trip. Now the natural question is, where do these borrowed shares come from? This is where ordinary investors accidentally discover they have been participating in the reverse gear without understanding it. If you hold stocks in a margin account, the broker often has the right to lend your shares out. Many people never read that line carefully because they assume my shares means the story ends there. It does not. In a margin account, your shares can become inventory in the lending market. The broker lends them to somebody who wants to short. That short seller pays a borrow fee, and the whole system quietly turns long holders into suppliers for the reverse gear. That is the fourth mechanism, the lending machine. Again, the public finds this odd because it wants ownership to be simple. But markets are built from layers of usage, control, custody, and legal fine print that the public rarely studies until stress reveals them. If you use a cash account, the restrictions are usually tighter, and shares are generally not lent without further permission. If you use a margin account, the door is much more open. Some platforms even ask you directly whether you want to participate in a stock lending program so you can earn a little income from your shares being lent to short sellers. Now notice what that means. The market is not a morality play. It is a machinery of claims. One person's passive holding can become another person's active bearish bet. That is how the system works. It is also why I tell people to stop talking about markets as though they were clean little places where good companies float upward and bad companies float downward in a dignified manner. No stocks are borrowed. Shares are lent. Collateral is posted. Traders hedge, brokers force action, short interest builds, squeezes happen. liquidity vanishes, crowds reverse. The reverse gear is part of the design. If you do not understand that, you do not understand the vehicle. Now, let me step back from direct shorting, because this is where many ordinary investors hear the theory, feel the danger, and then ask the practical question: can I express a bearish view without signing up for theoretically unlimited losses and a broker with a loaded margin, call pistol pointed at my account? Yes, that is where inverse ETFs enter the story. An inverse ETF is a fund designed to rise when a market or index falls. Instead of borrowing shares directly and managing the mechanics yourself, you simply buy the inverse instrument. In a basic sense, it functions like a reverse gear you can purchase outright. The market falls, the inverse fund rises. That sounds much safer because the capital structure feels cleaner, and in one important sense it is safer. Your loss is limited to what you paid for the ETF. There is no uncapped theoretical upside against you in the same way as a naked short position. But that does not mean inverse ETFs are simple, long-term solutions. They have a hidden weakness. I call it the daily reset decay. Most inverse ETFs reset daily. That one word should matter much more to you than it usually does. Daily means the instrument is trying to deliver the inverse of the market's move for that day, not for your dream of what the next 6 months ought to look like. Over time, especially in volatile back and forth markets, this daily reset can eat the position even when your broad directional thesis is not insane. The easiest way to picture it is the escalator problem. Imagine trying to walk up a downward escalator that changes speed every day. Some days you gain ground, some days you lose it, but the compounding of the path matters more than your simple intuition about the destination. That is what inverse ETFs feel like when held too long. The market can chop violently and the fund can decay in a way that shocks people who thought market down eventually was the whole thesis. It is not the path matters. This is the same lesson we saw in direct shorting, only in a softer costume. Path dependency is one of the most underappreciated killers in finance. You can be broadly right about direction and still lose because the route to being right was hostile to your instrument. That is why inverse ETFs are usually tools for shorter-term exposure, not some permanent bunker to hide in for years while you wait for civilization to validate your macro concerns. Now, by this point, many sensible people reach the conclusion that the reverse gear is real, useful, dangerous, and often too complicated for ordinary households to rely on as a primary wealth strategy. That conclusion is correct, and that leads to the fifth mechanism, the ordinary exit. This is the most boring and most useful part of the whole conversation. Regular investors do not need to imitate Michael Burry to protect themselves. They do not need to master swaps, short interest, borrow fees, and margin mechanics just to avoid being roadkill in the next downturn. The far more practical move for most people is to understand valuation, recognize excess, reduce exposure when the odds get stupid, and keep enough liquidity that a crash becomes an opportunity rather than a personal tragedy. This is not as glamorous as a legendary short. It is often much more intelligent. Sell when the market is obviously expensive enough that future returns have become poor and risk is being underpriced. Hold more cash or short duration reserves than the crowd thinks is fashionable. Wait. Then when the market falls, buy back assets at better prices. This is not easy in the psychological sense. Timing the exact top is impossible with consistency. You will look wrong for periods. You may exit too early. You may feel foolish while the crowd celebrates. But this ordinary exit strategy has one immense advantage over direct shorting. It does not require you to survive unlimited upside against you. It replaces the infinite pain problem with the patience problem. I prefer the patience problem. The public mocks patience because patience looks passive. It is not passive when valuation is insane. It is stored aggression. Cash in an overheated market is not nothing. It is deferred ownership at a better price. It is the right to buy when other people cannot. It is the refusal to confuse participation with intelligence. That is what ordinary investors should be learning from market crashes. Not that everyone needs to short the market, but that every bull market eventually seduces people into forgetting the reverse gear exists, and every crash punishes that forgetfulness brutally. Now, let me show you the deeper architecture because this is where the story becomes much more useful than the usual tutorial. There are really three ways to profit when markets fall. The first is direct shorting. The second is packaged inverse exposure. The third is strategic patience, combined with later acquisition. Each one has its own emotional demand. Direct shorting requires conviction, structure, and the ability to survive early pain. Inverse exposure requires timing, because the daily reset and path decay punish lazy long holding. Strategic patience requires humility, because you must look inactive while others appear to be winning, then act when fear arrives. Most people want the money from the third method with the emotional excitement of the first. That is childish. Real skill is choosing the method that fits not only your market view, but your capital structure, your emotional wiring, and your actual competence. This is where I separate spectators from allocators. A spectator asks, "How do I make money if the market crashes?" An allocator asks, "What vehicle fits my structure? What can kill me on the path? And what kind of downside exposure can I actually survive without stupidity?" That is a richer question, and it leads to a richer protocol. First, never enter the reverse gear without understanding exactly where the blow-up risk sits. In a direct short, the blow-up risk is infinite price movement against you and margin calls. In an inverse ETF, the blow-up risk is path decay and holding too long. In a sell and wait protocol, the blow-up risk is mostly psychological, missing upside. If you exit too early, re-entry failure if fear freezes you, and social embarrassment while others act superior before the drop comes. Second, respect borrowing costs and hidden friction. Shorting is not a free idea. Borrow fees matter, margin interest matters, forced liquidation matters. You are renting the right to be bearish, and rented conviction can become very expensive. Third, do not confuse being correct about fragility with being positioned correctly to profit from fragility. This distinction is everything. Plenty of people know bubbles exist. Far fewer build positions that survive the bubble long enough to benefit when the air finally leaves. Fourth, understand that crashes are not only destructive events, they are transfer events. Ownership moves from weak hands to patient hands. The greatest advantage a regular investor can build is not necessarily the ability to engineer an exotic bearish trade. It is the ability to remain liquid, clear-headed, and psychologically available when the transfer begins. That leads to the identity flip that matters most. At the beginning of the journey, the ordinary investor thinks the market is a place where you buy good things and wait. After learning the reverse gear, the investor understands something more adult. The market is a machine with multiple directions, multiple instruments, multiple traps, and multiple ways to get paid. Upside is only one chapter. Downside has its own structure. And if you never learn it, you are permanently dependent on optimism. That is not investing. That is weather dependence. The grown investor does not need to be bearish all the time. That would be foolish and exhausting. But he does need to understand the reverse gear well enough that falling markets no longer feel mystical. He needs to know what shorting actually is, why it is dangerous, why inverse products are not magic, why brokers protect themselves before protecting him, how lending works, and why the simplest intelligent move may often be reducing exposure and waiting with dry powder instead of trying to become a cinematic genius in derivatives. This is a colder and much more stable relationship with markets. You stop seeing crashes as monsters. You start seeing them as environments with their own rules. That is a very profitable psychological shift. Now, I want to say something about ordinary intelligence, because people often imagine the real skill in markets is prediction. Prediction matters less than the public thinks. Structure matters more. You do not need to know the exact day the market will crack to benefit from understanding the reverse gear. You need to know how to read excess, how to recognize risk, how to avoid fragile leverage, and how to choose between getting defensive, expressing a bearish view, or preserving enough cash to become a buyer later. That is not clairvoyance. It is architecture. Michael Burry's legend seduced a lot of people into thinking the point was to become a prophetic contrarian. That is too romantic. The point is to understand that if the market is a vehicle, you should know where the reverse gear is, what it costs to use when it becomes deadly, and when it is smarter to step out of the car and wait for the next road. That is the final lesson. Not every investor needs to short. Every investor needs to understand what shorting teaches. It teaches that downside has mechanics. It teaches that path matters more than opinion. It teaches that brokers do not love your thesis. It teaches that borrowing changes risk. It teaches that what looks easy in a simple example becomes dangerous in a real market. It teaches that regular people often have a safer and more powerful alternative in discipline, patience, and later acquisition. And it teaches the most important thing of all. A market crash is only mysterious if you never studied the reverse gear. So here's the final question I would leave you with. If the next big decline began tomorrow, would your current understanding help you profit, protect, or panic? Because markets do not reward the people who watched The Big Short and admired the drama. They reward the people who understood the machine. And the machine, whether it is rising or falling, always pays the structurally prepared first.